which I explained in the prior introductory video. So that's all about a disclaimer and expectation. And probably during this session, until I complete the PPT, I won't take any questions. But once the PPT is completed, if we have time permits today, I'll take the questions. Otherwise, I'll keep a separate session for a Q&A. So you can note down all the questions. I'll definitely answer those questions. But don't put it in the chat box, or if you want to put it, but I'll not be able to read that during the session or while I'm covering the PPT. Okay. Okay, so any session or any presentation, I start with this reminder, because this is something that we need to remember. Anything can happen in the market at any time. I may be extremely bullish, or the entire money in the world could be coming into our market. Still, the market can fall, or everybody would be selling. Still, the market can shoot up. If you remember, I'll tell you two examples. One is the demonetization. So I think 2016 November 8th or something, there was a demonetization. The next day, market opened extremely low. It was like, if you look at the candle, I think it was like 2-3% down. Bank Nifty was more than 1,000 point down opened, and the sentiments was extremely negative. And the opening was like a bloodbath. But if you remember, or if you go back and check that candle for that particular day, that day market closed in green after having such a bad opening. That is how the market is. And the second example that I can give is during the COVID time, we had lower circuit hit one day. Lower circuit means 5% down, Nifty and Bank Nifty. Bank Nifty was more than 5% down, and Nifty, I think 5%. Nifty was 5% down, and Bank Nifty was more than 5% down. And if you remember, even that day market closed in green. Opening itself, market was down, and from there it went further down and it hit lower circuit. But then market was halted trading for like 30 minutes. Then market reopened, but that day the market closed in green. So it is very important that anything can happen in market anytime. If you keep this in your mind always, you will never overtrade. I can see a lot of comments, lot of messages, lot of tweets saying that my entire capital wiped out. So the reason was you are overconfident, or you are so emotional, you forget that anything can happen in the market, and you keep all you have in the market, and the market turns around and you lose the entire life savings in one trade. So always keep it in mind. It will help you to trade with a reasonable risk. Okay. And the next thing is trading is a zero-sum game is what most people says, but I disagree, because trading is a negative-sum game. And of late, I have started seeing many people start saying that it's a negative-sum game. It is truly a negative-sum game, and hugely negative-sum game. If you look at your charges and brokerages and taxes, it is a huge amount of money that is going to the brokers and government. On top of that, if you make money, out of that you will pay income tax or capital gain tax, and all these stuffs you are paying into the government. All these are outflow from the market. So let's say I'm making 100,000 or 1 lakh rupees, and somebody else is losing. I'm losing 1 lakh rupees. That doesn't mean that the person on the opposite side make 1 lakh rupees. He might be making only 50,000 rupees, or he may be making only 10,000 rupees. Remaining 90,000 rupees may be going as brokerages, charges, taxes, income tax, and all. Because it is not that in one trade I'm making 1 lakh and I'm losing 1 lakh and he's making whatever money he's making. It could be in a year time. While making that 1 lakh for the whole year, he might have paid maybe 50,000 brokerage and other charges, plus some other money as internet charges and other expenses related to the trading, right? So it is hugely negative sum game. So even in a zero sum game, somebody else will have to lose money for you to gain money, right? But if it is a negative sum game, even if somebody is losing the money for you to gain, you have to be extremely competitive. You have to fight with the expenses, charges, and everything. Only after winning all of these, you will be succeeding. And whereas investment may not be a negative sum game, because while investing in the market, the market creates wealth. Because if there is a stock if there is a company which is growing from 100,000 rupees market cap to $1 billion or whatever higher market cap, it is actually creating the wealth. It is that all the investors in that company can make money. There is nobody or nobody will have to lose money for others to gain if it is proper investment in a good company. But trading, especially derivative trading, it is a negative sum game. So you have to put a lot of effort. I'm telling this because somebody who is taking the trading as a career will have to put in a lot of efforts. You have to learn a lot of things and you have to win over your psychology and everything for becoming consistently successful. It is not an easy task. People come into the trading thinking that, okay, I can come, I can trade and I can make a side income while I'm working, but that is not the case. And trading is a business, it's not a gambling. So most businesses have less than 10% success ratio. So as trading. So this is not what I am saying, but most of the startups and other things based on the survey and studies, people are reporting that only less than 10% of the businesses succeed. Maybe if you take 5 year time frame. So trading is also similar. It is not that okay, all the traders are making money, neither all the businessmen are making money. And so many people are coming into the trading because ease of entry. It is very easy to open a brokerage account and start the trading, right? So many people are getting attracted. You can sit at home, you can do the trading while traveling. So it's very easy. But this ease of entry brings a lot of people into it. You need to you need to compensate that factor with execution excellence. You have to execute your plan, you have to study, and you have to trade professionally to sustain here. And losing trades are a part of the business and consider them as a cost of doing business. So there is a book called Thinking Fast and Slow. In that, that was written by Daniel Kahneman, and in that he says he's an economist. He's a behavioral economist, and he says when you make a money and when you lose a money, the emotion is different. That is obviously something that everyone knows, but the joy that brings while making money is far lower than the pain that comes along with losing money. Let's say you are losing like 10 rupees and the amount of pain that you go through while losing the 10 rupee, the equivalent happiness if you need to get, you should at least get maybe 30-40 rupees. That's what the study says. So that is why it is very difficult for people to accept the losing trade. But you need to accept the losing trades, cut the losses short, and make sure that you understand that it's a part of the business. And losing trades is the cost of doing the business. And like any other business or profession, trading requires substantial amount of time, effort, and money to learn and to succeed. So it's not that okay, somebody can come start trading and make the money right away, but it is directly it is directly proportional to the effort and the time and the money you dedicate to learn the stock market and trading and psychology. So approach it as a business, not as a gambling. You need to learn, you need to analyze, you need to see what is the probability, what is the risk reward and all. So we'll go through all of that, and we'll explore all of that in the coming slides. Okay. And one thing, I've been talking a lot about the psychology, right? Psychology has different factors in the trading. So here, 1% win in the market because only that much of means approximately 10% of the people are winning in the market if you consider investment also. Means if you consider, but the people who are actually beating the market with more than FD interest rate, it is less than 1% of the traders. So the reason being, I believe only less than 1% of the people are putting the required effort. And the people who are trading in the options market, many of them may not be knowing what is option and how the pricing is done, and majority of the movement what is happening in the options, they don't know how it is happening. So people are simply coming and trading. Many people, not everybody, many people. The people who learned the nuances and details of the trading, I don't think too many people will be losing. And many people are not staying in the market longer enough to become consistently profitable. Before that, they gamble with all the money and they lose everything in the market. So what I'm trying to say is, so if you want to win in the market, you need to trust yourself that you can win in the market, and you need to put in the required effort. So that perseverance is required to become a winner in the stock market. And the fear of failure and fear of success. These are the two things killing the traders. Fear of failure is you're not able to take a trade thinking that if what if the trade goes wrong? The trade can go wrong. Any trade that can go wrong. So there are certain times when the trend is very extremely bullish, I take the long trade, and it may be moving slightly against me. Then it comes back and it gives me money. Then after a while, I mean, after the trade is closed, many people are asking me, uh, what was the surety you had that the market would come back up? Then I used to say, I didn't have any surety, because I know one day or other the market will reverse and I lose money. But the trend is up, the probability is very high for the market to come back up. So the chances are extremely high for me to make money than losing. But if the market doesn't come back, if it is going down continuously, and if I'm losing the money, I know how much I can lose. I'm okay with that. I'm okay to spend that money to gain the winning trade. So that's what fear of failure is not required, because there will be failures. When you trade, there will be losing trades. So just that you need to understand there are losing trades for getting the winners also. The only thing that I consider is my winners should be bigger than the losers. If I'm potentially, if I can lose 10 rupees in a trade, and if that trade becomes a winner as I think, it should give me at least 15 rupees, 20 rupees, or 30 or 40 or whatever higher amount. It is not that, okay, I take a trade and I'm losing, if it goes wrong, I lose 10 rupees. And if it becomes a winner, I get 5 rupees. No, those kind of trades I try to avoid. And how to spot that, we'll see. And fear of success is also a problem. Many people, the interesting thing is, many people I know, they start trading and they continuously make money for 3 4 days. Then one thing, winning, they get obsessed with the winning. And second thing, they think, okay, what other people are thinking if I'm making too much of money, that thing coming into their mind, and automatically they go into the losing trades. They themselves will not be knowing how they're slipping from so confident winning trader to a losing trader overnight. So Zig Ziglar is a motivation. He was a motivational speaker. This is one of the very interesting and very motivating quote from him, which I often read. You were born to win, but to be a winner, you must plan to win, prepare to win, and expect to win. It is very important. You must expect to win, and you need to prepare to win. It's not that there are many people who are living in the someday aisle. Like someday I will become disciplined trader, or someday I will stop smoking, or someday I will start exercising. People are thinking that way, but they are not planning it. They are not preparing it. They are not expecting to do it. They are just hoping that it will happen someday. It will not happen someday until you take the action, and you need to plan and execute it. Okay. So these are the slides that I'm covering to set the stage for the trading, because trading or strategies or market analysis alone will not make a trader successful. So these are the things that made a change in me. So I thought, okay, this will be helpful for many people, if not everyone. So that's why I'm covering these kind of things also. Okay. So now I think probably I can move into the next slide, which is probably the start of the session. So there are trading resources that I use. There are so many trading resources that I use. There are a lot of questions I receive from so many people. What are the things that you use and all? So here, 1 second. Okay, so whenever I need any data or any historical data or information, I go to NSE India website and I download it. And you can just search in NSE website, or you can search in Google, keeping NSE in the keyword. It will take you to the NSE India website, maybe open interest or historical data. A lot of data is available, but Some of the data are paid, but even free data is enough for us to sustain, because the paid data is mostly for institutions and HFTs, high frequency traders. Whatever data is available in NSE is free, which itself is mostly good for us. And for the charting, I use TradingView, and one more charting platform I use is Go Charting. Go Charting gives a little more detailed charting information, but it is not as smooth as TradingView, so I use both. Go Charting is good for maybe volume profile or market profile and other things, but TradingView is good for normal charts and indicators and information. And for any data release and other stuffs, most people are using investing.com, but I prefer to use tradingeconomics.com, because most of the time, even Indian data, it is releasing real time. Like if there is a time mentioned, and if you keep it open, I often find that trading economics provide the data release real time, like interest rate decision or many other things like PMI and other kind of data. It is coming real time. So I prefer to use trading economics than investing.com. And whatever I am saying here, it is not a recommendation. It's just what I am using. There could be better one. There could be much better one that you are using. So it is okay. That's fine. End of the day, we need to get something. And I'm covering here because many people don't know where we can get this kind of data. So during the day, if you want to do during the day or after market hours, if you want to track the global market, there are different platforms. The best one I found is IG.com. In IG.com, it is very fast, real time, and most of the time it is active. Even over the weekend, you can see weekend Wall Street and other stuffs. You can see the global futures market, how those are moving. Are they moving up or down? So IG.com, there are different indices listed there, and you don't even need a login. The website, free website itself gives it, and if needed, you can create a dummy login that will give you more access to the charts and other things, which is actually not required, because the free itself, without login, you get more information. And I use OI Pulse for OI Builder. Many people are using different platform like Sensible or anything. It is okay. Whichever things you are using, it is absolutely fine. So I have taken subscription for OI, so I am using it. It is quite good, and there are many other platforms which are good. So I'm not saying that OI is only good one, but OI is good, and I'm comfortable with that, so I'm using it. And brokers, I'm using three brokers: Zerodha, Kotak Securities, and ICICI Securities, because I split the money into three different accounts and trade differently for my risk management. And in case if there is an outage or something, I need to manage my risk and everything. So I use three brokers. Zerodha, I'm using Orbis platform, wherein there is no restriction for out of the money options and all. But the restriction here in Orbis will be you will not be able to invest in this in the stocks, and you will not be able to do the pledging also. That is the restriction with the Zerodha Orbis. But trading derivatives, there is no restriction. But BSE derivatives are not, Sensex options are not available in Orbis. And Kotak Securities I use. The advantage is that it is zero brokerage, and it is a reputed bank owned security, means brokerage. And I feel much more safer with the Kotak and ICICI. ICICI I'm using, I'm not so comfortable with their platform, but they have improved a lot of late. They have the execution algos and all if you want to take a bigger position. And the biggest advantage is my bank account is ICICI, so I can seamlessly transfer money in and out. So the primary platform for trading I use is Zerodha, because from my experience, their platform is extremely good. There could be many other, but these are the three ones, three brokers I'm using. Okay. So one more thing, why am I a discretionary trader? So indicators are commonly used and may have to frequently change the strategies. System-based strategy may not give more than the average return. So there are a lot of system-based strategy which are working, but the return that you get, it could be average. But if you're a discretionary trader and if you are focused on one type of trading, there could be sometimes you will see extremely big opportunities where you can make enormous amount of return. So it may come very rarely only, but you get that kind of opportunity. But once you become based trader, it will be very difficult for you to focus on such things. And there are big institutions in the market. They've got advanced systems and algos. Their systems are very advanced. And if there is any system-based strategy that can mint higher than the average return, definitely their system will scan it, and their system will be able to find out those kind of opportunities, and they'll deploy large amount of capital, which will fade out the higher return. So that is the reason. These are the reasons, and uh, these are the reasons I want to stick as a discretionary trader. And trading only indices help me to keep watching the same indices for so many years, and that helps me to understand the nuances of different moves. Like until recently, I was trading only in Bank Nifty, so I was so familiar with most of the Bank Nifty patterns and other stuffs. I have intraday chart saved for so many years. Plus, I keep watching the stocks which are contributing to the Bank Nifty moves, like HDFC Bank, ICICI Bank, IndusInd Bank, or Kotak Mahindra and Axis Bank. All these stocks I watch very closely. So how their moves are contributing to the indices and all. And one simple observation which I've been experiencing for like 3 4 years, I can tell you, you can go back and check out. You can check that in future. Kotak Mahindra Bank is a contra stock. When most of the banking stocks and the banking indices are in Bank Nifty is going up, Kotak Mahindra mostly goes down. When uh, Bank Nifty is moving down along with most other stocks, Kotak Mahindra Bank would be ideally going up. So it's inverse. So that's one observation. Similarly, there are lot many things. There are certain stock they use for managing the index, which you can clearly visible, which is clearly visible when you keep on juggling through the stocks, which are the high weighted stocks. Okay, so I'll move on to the next slide, which is option Greeks. And trust me, if you don't know, just read, understand, and learn about option Greeks. It will help you. But if you know option Greeks, you don't have to focus on that too much. It is a good to know things. Once you understand about option Greeks, you will understand the kind of move that is happening, and what are the advantages and disadvantages in different kind of market. You will be able to understand a lot of things. But don't overly rely on option Greeks. It doesn't mean that you need to know the option Greeks to make money. No, it is not at all required. But giving option Greeks will help you to analyze the market and analyze the options a little better way. But you don't have to break your head and read and focus too much on option Greeks. But it is a very good to know information, because we are trading options. We are trading options. So we need to know what are the components and what are the benefits and what are the patterns and other stuffs, right? So what are the contributors also? So option Greeks will explain that better. So I'm not explaining this. I just want to tell you. If you don't know, you can just Google and you find any videos about option Greeks and watch it. That's enough. Okay. So now we are coming into options: ITM, OTM, and ATM. So guys, I'm going a little fast here, or throughout the session I'll be going fast because it's a recorded session. It is available in YouTube. Anytime if you want to get a repetition, or if you want to listen to that again, you can always go back and listen to it. So there is no point of me repeating again and again the same thing or going too slow. So you can pause, you can repeat, means you can pause, you can repeat, and you can listen to that one again and again. That is the reason I am going too fast, because the faster I complete, we'll get more time to have the Q&A and other stuffs, right? Because there are certain areas where it requires substantial amount of discussion to understand the concepts. So when it comes there, we can spend more time. Other things I will go a little fast, and many people may not require some of these things. They can skip it also, right? So if somebody needs, literally needs it, they can spend more time on this. So that's the reason I'm going fast. Okay, here options, most of you must be knowing OTM, ITM, and ATM, right? And here I think I forgot to tell one thing at the start, because I'm not giving a training right from the basics, because basics are available for free In a lot of places, a lot of videos are there. I'm intending to give this refresher or nuances to the people who are already trading in options. And if somebody who's not trading in options, and if you find it little difficult to understand, you need to go back and learn the basics. Then after that, you can come back and you can listen to this video. Then it will make more sense. Because I know there'll be quite a few people who are not actively trading in options would be listening to this. It will be a little difficult for you to grab at the first place. But once you learn the basics and come back, or once you execute few trades in options and come back, it will make much more sense to you. Okay. So ITM in the money, ATM at the money, and OTM out of the money. So the pros and cons. So many people ask me how I select the strike prices. Typically, I love to trade on at the money options, because when the market moves reasonably good, that gives you the better risk reward ratio. OTMs give you extremely good money as a buyer when the market moves drastically, like when there is a like 1%, 2%, or 3% move in the index, OTM gives like enormous amount of return. But if it is a very small moves, if it is for scalping and all, I prefer to go with ITM. Like if you look at my Nifty trades, mostly I go with ITM, because Nifty I'm not comfortable to ride the trend for long, because I'm not that familiar with Nifty trading, because I've been trading with Bank Nifty for a very long time. So I know how the option prices moves according to the index movement. So Bank Nifty I mostly trade slightly OTM or ATM, but when I trade in Nifty, I trade ITM. And when you trade in the money, you can capture even the smallest move also. Like even if the index is moving like 10 points, if it is not taking too much of time for the 10 points, you will get some part of it in the money options. But if you're trading out of the money, you have to get at least a reasonable move for getting the profit. And if the market is stagnant for some time, out of the money will start losing majority of the premium. Same goes for the at the money also. So while trading, OTM prices multiply very easily, like zero hero trades, and there are when you're expecting huge volatility or huge movement, and the OTM prices are very low, it is okay to trade out of the money as a buyer. And ITM and ATM, it doesn't multiply. Let's say you're deploying 10,000 rupees in one trade, and if you're buying OTM, and if the trade multiplies, it can become 20,000, 30,000, or 50,000, or even 1 lakh. But if you're trading in ITM, if you're deploying at 10,000 rupees, ATM may become 20,000, 30,000 at times, or even 40,000. But ITM, which is very hardly becomes 10,000, very hardly becomes 20,000, 30,000 and all. If there is a move which can make ITM options double, the OTM options can multiply many fold. That is the difference between ATM and OTM in terms of multiplying. But the problem is, if the movement is very low, ITM will be more profitable. On the OTM, you may not even get anything, or sometimes you may even lose money also, even if the market is moving in favor of you. And OTM is good for catching trending moves for a buyer. So if there is a trending move, and if the market is continuously, you are expecting the market to move continuously in one side, one direction, you can go with OTM buying. It will give you very handsome profit. And ITM and ATM is good for scalping for a buyer and seller. Even for a seller, for scalping few points, at the money or in the money selling is very good. And OTM, safe for selling in a boring market, because when there are times when the market is like in a consolidation phase, and it is not giving any trade. Like predominantly, I'm an option buyer, but when I'm seeing that I don't get any option buying trade opportunities, I'm waiting for a trade. I'll be tend to do the unnecessary trades, right? Because we are waiting for a trade for a very long time. Then after waiting for 1 hour, 2 hours, if the opportunity doesn't come, we might try to grab the half-baked opportunities. Just to avoid that, while waiting for a perfect buy opportunity, I do some OTM selling. And as long as the market is moving sideways, and if it is boring, it will keep on giving me some premium decay. And anytime if it starts moving And if it breaks out and the OTM selling is giving me some small loss, that means the market starts moving and it is ready to give me a buying opportunity. In that time, I just exit the selling trade, regardless of profit or loss, because my selling trade will be very small quantity compared to my buying trade. And it will be like, if it is OTM, even if it gives a loss, it will be very minor loss, which I can ignore, and I can grab very easily that from the buying trades. So OTM selling is a stopgap arrangement for me. And for as a seller, if you want to grab a what to say, trending move, it's always good for it's always good to sell ITM or ATM. So you are expecting a trending move in the market, and if you are going ahead and selling the OTM, you may hardly get 10 rupee, 20 rupees per share profit, which may not be a good option considering the risk reward, right? But if you're expecting a trending move, and imagine Bank Nifty at the money option is trading at 250 rupees, you are selling it, and the market is moving like 300 points in favor of you, and it becomes 75 rupees. That means you are getting 175 points as profit, right? So for a trending move, if you're an option seller and if it is difficult to buy options, or if the premium is extremely high, selling ITM or ATM is better than selling out of the money. These are things that everybody knows, but there are many people who keep on asking me on what basis you select the strike price. That's the reason I repeatedly covering this. And OTM can earn consistent, but one large means when you are a seller, selling OTM options can earn you consistent money. But the problem is one large move can take multiple trades profit if there is no stop loss. But if there is a stop loss, it can get frequently since the movement is higher in percentage terms. Let's say you are somebody who is selling a Bank Nifty options which is worth maybe 30 rupees. Consistently you are selling 30 rupees. Most of the times that goes to zero and you make money. But the problem is when the market is volatile, this 30 rupee option will go to 40, 50, 60, 70, then come back to zero. And when it moves into that kind of situation, your stop loss will multiple times get hit. Like you sell for 30, you keep a stop loss at 40, and it hit the stop loss, go to 40, 50, then comes back. Maybe you will re-enter and you will make some points, but the frequency of hitting stop loss will be very high. Imagine you are not hitting placing a stop loss. You are selling it for 30, it went to 40, 50, 60, 70, and came back to zero. You made 30 rupees. Next time also you did that. Next time you sold for 30 rupees and it directly came to zero. Next time again it went to like 50 rupees and came back to zero. Next time you are again selling another next week, and again you are selling for 30 rupees. It went to like 40, 50, 60, 70, 80, 100, 200, and there is no stop. Many people get trapped this way, and it is not imaginary. When you listen from me about this, many people feel that, okay, what stupidity, who will be that kind of stupid? But this is what actually happens in the market for the people who are selling OTM options. So be mindful about this fact while you are selling OTM options. That is the reason I rarely sell OTM options, and whenever I sell, it is only while waiting for the setup. And whenever it breaks out and whenever it starts seeing the loss, I just get the heck out of it. I don't keep it. So if your bread and butter is option selling, and if you are poor in risk management, I would suggest I prefer to do it in ITM or ATM than doing it in FAR OTM, because when you make profit, you make in pennies, and when you make losses, you will make in dollars. That's what happens with the penny option sellers. Imagine you are a at the money option seller. You are selling options worth 200 rupees always, and whenever the market comes in favor of you, you make most of it. Maybe the entire 200 will be your profit. And when you go wrong, maybe 100 points you might be cutting the losses. 200 become 300. You cut the losses, and the frequency could be most of the time. It will be more than 50%. You will be gaining. That is what actually happens with the ATM selling. And even if the trade extremely goes wrong, and imagine you are not keeping the stop loss, that 200 become 600 maybe. extreme worst case, right? In extreme worst case, it maybe becomes 600 one day. That will be only three times of profit. But when you sell out of the money option for 10 rupees, and if when it becomes 100 rupees, it is taking away 10 times profit. Or when it becomes 200 rupees, it takes out 20 times profit. So consider these things. It is not that, okay, I'm putting a case to you and telling that, okay, this is the right thing. No, there could be multiple other right things, but consider these facts, analyze these facts, and observe it and find out the right balance for you. Maybe you can sell OTM and combination of OTM and ATM and ATM, or means whatever ways suits for you, you can find out. But consider these risk parameters also while trading in options. And buying also, buying I covered already. That's the reason I was covering in the about the selling in the second half. Okay, so hmm, so that is about out of the money, at the money, and in the money options. So next, I want to cover one thing which is very basics, which is something that most people talk big thing about it. Because if you go to Twitter and read the tweets about the trading, most people often says, I take only 1 is to 3 RR trade, or this trade is giving me better RR, or if you do this, the RR is extremely good. Many people are talking about it. So it is a big word, big buzzword, RR, risk reward. But the same people, when they are into a trade, what you can see is, imagine somebody is buying an option for 300 rupees and it becomes 350 rupees. They can't, what to say, they can't bear with the profit and they just book it. Let's say they bought 1000 quantity for 300 rupees, which is like maybe 3 lakh rupees they spent on the trade, and it becomes 350 rupees. The 50,000 profit when they see on the screen, for no reason, just because of profit, they book it. And when it goes opposite, they may average it. So three times they booked 50 rupees profit. Fourth time they took 1000 quantity, it went to 250. They added another 1000. The average became like 275, and it again went another 25 rupees down or 30 rupees down. They took another 1000 quantity, and it further went down, and they lose the entire profit they made in the previous 10 trades, plus they lose some part of the capital. This is what happens with many people, because they talk about the risk reward ratio, but they are not concerned about the risk reward ratio while trading. So while trading, you just need to make sure that your profit, potential profit, or your profit is more than the potential loss. So here this is a calculator, nothing big, it is just a Excel formula. So let's say your winning probability is 50 percentage, and losing probability is obviously 50 percentage, and risk reward. So against one risk, you are getting one reward. So you are losing one trade, winning one trade. When you are losing one. When you are winning, you are winning one. So 50-50, and you are ending up with a zero, and maybe you will be losing only the brokerages. But imagine your probability is only 50 percentage. So winning probability 50 percentage, losing probability is 50 percentage. Your risk reward ratio is 2 is to 1. So 1 is to 2. So when you are losing 10 rupees. When you are winning, you are losing 20. Sorry, when you are winning, you are winning 20 rupees. When you are losing only 10 rupees. So in such cases, on an average, a series of trades, you will be net profitable for about 17 percentage. So that's how it plays around. In this, if you keep changing the winning probability, losing probability, and risk reward ratio, it will tell you approximately how much will be the profitability. Like, even if you have like 75 percentage winning ratio, 75% of your trades are winners, but 25% of the trades are losers. I think that formula is incorrect. So here, yeah, you are risk reward. I think I did update here, but if it is 1:1, you'll be profitable. But I think this formula is incorrect. But 75% or 80% probability, winning probability doesn't give you the profitability, because if you're winning like 10 rupees and losing like 50 rupees or 20 rupees, you're not going to make money in the long run. See here, maybe 75%, 25% is losing probability, and 1:1 risk reward ratio, you are getting 25%, but probably you are 0.5% is the risk reward. You are getting only 8%. Let's say you are winning 20 rupees and losing 100 rupees, like 0.2% is the winning ratio, then net to net you will be losing the money. So always consider winning ratio along with risk reward ratio, because make sure that your winners are better than the losers. In a trade, if your potential loss is like 10,000 rupees, the potential profit in that trade should be more than 10,000 rupees. That's what you need to consider. That's how I look at the trades. Because when you're taking the trades right near the resistance and you're taking a long trade, it's very difficult. Unless the market breaks out and gives you a handsome profit, it's difficult, right? So, and when you are into the trades also, for no reason, don't book the profit. If you're taking a trade for a reason, as long as the reason is valid, keep trading the profit. Maybe you can put a trading stop loss, or maybe you can book a small portion and keep the remaining portion and ride the remaining portion. As and when the market goes up, we can keep booking small quantities and ride at least small portion. So that will help you. So that I will cover how to get these kind of better trades. There is another slide for that, but always remember that risk reward ratio is most important and equally or more important than the probability. Probability is also important, but risk reward ratio is much more important. Without a good risk reward ratio, many people become losing traders, and that is the highest reason why people are not consistently successful, or in a longer time scale people are not successful, because their losers are big and winners are small. Okay. Okay. The next thing is risk management. Position sizing, money management, and risk management. So these are the three things which is tied together, which is very important of the trading, which is the core of trading. Because without having a proper position sizing, without having a proper money management, without having a proper risk management, you cannot win in the market. And if you look at my Telegram channel, in the past, when the market was like sideways, you see I have a lot of losing trades. And most of the trades I was losing like small points, 10 points, 20 points, 5 points, 2 points and all. But when the winning trade comes in, it was coming in, maybe many of the trades were like doubling, tripling and moving up substantially, right? So that is the importance of risk reward ratio also, plus position sizing also. If you are not sizing your position properly, when you get into the losing trades, it will take out more money. And if you're not managing your money, what happens is 10 days you are winning. All the winnings you are compounding and taking the trades on 11th day. 11th day, if you're losing a small percentage also, you will be losing most of the profits you earned in the previous 10 days. So that is the importance of position sizing and money management. So I'll tell you how I do it. Just give me a second. Let me grab some water. So I'll explain you how I do it, and based on that, you can whatever learning you are getting from these slides, you can apply that, and you can optimize your position sizing, money management, and your risk management. It's not that this may not work for everybody, because depending on the trading strategies and trading styles and psychology, you may have to find out something good for you. Okay. So I usually trade with fixed capital, not fixed quantity. Let's say if I'm deploying 10,000 rupees on my trades, certain times I'll be buying options worth 200 rupees. So in that case, I'll be getting maybe 500 quantity only, right? Sorry, if I'm trading with 1 lakh, and if the price is like 200 rupees, I can buy maybe only 500 quantity. But certain times I buy options worth 20 rupees. In that case, I can buy 5,000 quantity. So that is my trading style. It is helping me because certain times I'm getting like 2x, 3x and all. So those kind of trades I look very often. That is the reason I trade with the fixed capital, not with the fixed quantity. I don't take like 100 quantity every time or 10 quantity every time, but I use the fixed amount. If I'm taking trade with for 1 lakh rupees, and most of my trades will be for that 1 lakh rupees, whether the price is like 10 rupees, 100 rupees, or 200 rupees. That is one thing. And only 10% of the total trading capital, keep it in the trading account. That is one good practice, because when I am an option buyer, it is not wise to take a trade with the entire trading capital, because if your trading capital is like 2 lakh rupees, if my trading capital is like 2 lakh rupees, I prefer to keep only 20,000 in the trading account, and I do the option buying only for that 20,000, because it is not wise to risk more than 10%. Even 10% is extremely high for option buying. And ideally, when you take a risk, that risk should be less than 2%, is what most people say. I increase it to up to 10% in certain cases, because I have pretty good winning ratio, so I can bet little higher amount. So the reason many people coming to option buying is saying that option selling needs more capital. So that is the reason many option buyers are going broke. Because if you are allowed to sell one lot option, naked option for 1,50,000, I would suggest when you buy options also buy only one lot for 1,50,000. Because the exchange required margin may be very less, it could be like 15,000. But if you want to manage your risk properly, and if you want to stay in the market for longer, you have to deploy that that discipline by yourself. Because if you buy if your capital is like 2 lakh rupees, and if you keep on buying options for the entire 2 lakh rupees, or at least 50% of the capital or 25% of the capital, let's say your capital is 2 lakh rupees, you are deploying 25%, like 50,000 in one trade every time. Continuously, if your 2-3 trades are going wrong, then the majority of your the trading capital is gone. And even if one trade goes wrong, out of 2 lakh capital, 50,000 you are deploying, one trade goes considerably wrong, you are losing like 50% of the value. That means the overall capital from 2 lakh, you are losing like 25,000 you are losing in one trade. That will dent your capital first, that will dent your psychology second, and you will not be able to trade properly because you lost a substantial amount of your capital. So always risk small money. And the funny thing is, I've told this to many people during the mentoring session, and whoever was able to successfully reduce the exposure to the capital, they all were making more money than what they were earning with higher capital. So that is the beauty of lower exposure compared to your capital size. So you have 10 lakh capital doesn't mean that you need to deploy the entire 10 lakh. Put only 50,000 or 1 lakh, and then you can trade fearlessly. You can take it, and even if there is a loss comes in, that loss will be less. And even if there is a profit comes in, you will be able to write the trade without worrying about the profit. Because most of the time, imagine you are taking a trade with the 10 lakh capital, the entire 10 lakh, and that trade is giving you like 50,000 profit. You will be nervous. 50,000, 60,000, you'll be nervous and you will start booking the profit. Imagine you are deploying only 1 lakh out of the 10 lakh, and that trade gives the same percentage, 5,000, 6,000 profit. You will be able to comfortably hold. If there is no reason to exit the trade, you will be able to hold the trade. Instead of looking at the P&L, you will be able to look at the market and trade well. If the trade has potential to give you like 20,000 profit, you will be able to ride and get the 20,000 profit. Imagine your risk is very less there compared to the 10 lakh, but your reward is very high. On a longer time scale, you will be much more profitable than using the 10 lakh, because with the 10 lakh, when you are losing, you will be losing big money. But with the lower exposure, you are losing less money, but you are gaining more because you're trading well without looking at the P&L. So this is what I do. You can find out a suitable percentage for yourself. And when my account size grew, I split this 10% into three and deployed it into 3 different accounts. Imagine my trading capital is like 10 lakh. I took 1 lakh, and that 1 lakh I split into 3, maybe 40, 40 and 20. I put in 3 different accounts, like 40,000 in one account, 40,000 in one second account, and 20,000 in third account. So most of the times my options buying trades, I start with the smallest one, 20,000. And when I get a better opportunity, I buy in other accounts, and at the worst case, or the best case or worst case, whatever you call it, my exposure will be this 10%, and that will be very rare. In such cases, that will be like very high conviction, very high risk to reward trades only. I go into this situation. Okay. And I keep this amount constant in my trading account. So if I make a profit, I withdraw the profit on the same day. If I make a loss, I add the money back into the trading account and keep this money constant in my trading account so that I can trade fearlessly. I know that even if this trade goes wrong, it is not going to impact me because I can backfill and trade with the same amount. As long as the market is there and I am sound and I am alive and well, I can keep on trading well and I can get back on track anytime. So that's why I keep small amount of capital in the trading account. Okay, that's how I do the position sizing and money management and risk management. So people are obsessed with the stop losses, but I'm not, because I use stop losses rarely, but rather than using stop losses, I size my position in such a way that even if the entire option buying goes out, I'll be okay, because my deployed amount is very less. So I'll be able to sustain through the fluctuation. And even in option selling also, my position sizing is very low. So you might have seen that at certain times when I sell options, even if it goes double, I keep it certain times because my position is very, very low in selling. And buying also, you can see that certain times my position goes completely wrong. Certain times it goes to zero also. Like I buy for 100 rupees something, and end of the day, if it is a expiry day and if the trade doesn't work, end of the day it goes to zero also. Because my position is very low, I know I can afford it. Like it could be maybe 2% of my capital or 1% of the capital certain times. So I know I can leave it to zero. So that is how I size my position. Because the option that I bought for 100 rupees, only when it has the potential to go to like 200, 300, 400 rupees, I am ready to take that kind of risk and keep it longer time, and I allow it to go to zero also. And most of the time, the moment I realize that I am wrong, I exit. Like I buy 400 rupees, it becomes 80 or 120 or whatever price. If my trade is not the market is not moving the way I expect, I just get out of it without looking at the P&L. But certain times, my conviction is so good that I expect the market to come into my way. And those days I keep it, and most of the time it comes back because there could be some or other reason for doing that. And certain times it doesn't come back. And when it doesn't come back, it punishes me. And when it comes back, it rewards me really well. And many of you would have seen that in Telegram. And the mentorship people would have seen that live doing all of this. And there's a time as well. If I take an intraday trade, end of the day, no matter what, I am out. And if I'm taking something for carrying over, I do it. Otherwise, if it is taken as intraday, regardless of the profit or loss, by end of the day, I'll be out. I don't want to carry the intraday or convert the intraday position into the overnight position and incur more losses. And if the reason for entering the position is not valid later, exit the position regardless of profit or loss. Let's say you are taking the trade because of the open interest or because of any specific reason. You follow a setup, and based on that setup, the trade is good, and you enter the trade. And without even looking at the P&L, you look at the reasons, the trade setup. As long as that is valid, keep on holding it. And the moment you realize that it is not working anymore, just get out of it. Don't look at the P&L. When you look at the P&L, that P&L may be 9,500 or 9,900. You think that, okay, if there is a 100 more, it will be 10,000 and you may not exit. But without giving you that profit, it can start sliding to 8,000, 6,000. Then it comes to 4,000. Then okay, next time it comes to 5,000, I'll book. It may not even come to that amount. So don't look at the P&L. Look at the trade. As long as the trade is working, keep holding it. As long as the moment that the trade is not working, just get the heck out of it. And whenever I do the sell option, I always have the hedge. So there are two reasons, one for the margin benefit and one for avoiding the unlimited loss. So even Bank Nifty could be maybe 700 or even 1,000 points away, but at least it can save me from the unlimited loss. Just that any black swan event happens will not uh, drive me out of business and life. So just keep some edge always for the option seller. So that's how I manage the rest. Certain times I keep SL, but most of the time I keep position size and my view. As long as my view is intact, I keep the position. The moment my view is not working, I get out of it. Okay. So it's too much in one stretch. So let me see some comments and see if there is any specific things to note here. A lot of interesting discussions are going on. Okay, not trading was a lot of interesting discussions are going on in the comments. So, do you do fib analysis? Fib, I don't do. Oh, isn't my phase in a small window? I thought my phase was there in the small window. 1 second, give me. Okay.